So I know this was kind of something we didn't really go a lot of detail in, but just so people understand, interest rates, the dividend rates that you get on the policies, they go up and down similar to the interest rates of the market. So the prime rate that's set by the Fed, for example. And what I would do or suggest is research. You can look up companies and you can look up their dividend history. You can see how often they've paid dividends. You can also see like the percentages of dividends and how much it was. Like, I think I looked at something last time and it was going back to like sometime in like the 1900s, maybe like 1960 something to like now. And you could kind of look at it and see like, okay, here was the rates. And then here was when, we had this recession. Here was when we had this recession. And you can kind of see. And those are the companies that if they still paying or are they raising the dividend rate in a recession, that's always a good sign. What you don't want to see is a bunch of dividend cuts. And honestly, for me, when I look at the dividends, I look at it from the same standpoint of kind of being like an investor and looking at a company that pays dividends. And there's other things you can look at too, as far as like dividends. You can see how much, like the ratio that dividends are paid out versus like the cash on hand. And another good one to look at is like the solvency ratio of a company, especially insurance companies. And basically what it is it's the ratio of assets and debt. One other thing.
Sorry, Dwight. So basically, can you pay your bills at the end of the day, right? If they have too much debt and don't have enough assets, they can't liquidate that and cover, their debts. And so that this is what people, if you are into stocks and you trade, this is when you are when you do not technical analysis, is fundamental analysis. Fundamental analysis, you're going to look at the company's report and you're going to see what their debt, what their cash flow statements look like and see if they're able to cover it.
Yeah, honestly, from a fundamental and technical analysis standpoint, if you understand it in stocks, real estate, or any market, you can duplicate that same mindset and the same understanding to any market. So other factors, as far as dividends, so there's a interest return, which is a credit from investments. There's a mortality return. So, for example, each company has a anticipation of how many death claims they're going to have to pay. And then you get a credit back when there's fewer death claims. And then the last part of the dividend factor is expenses. So what happens is they take out any cost for expenses and everything after they give you the credits for the returns of the investments and the credits for lower death rates. And this isn't just, so this is the three factors of dividends. But I don't know if anybody's noticed this. I know it definitely happened during COVID. Like, for example, like my auto insurance company gave me like a lump sum reimbursement back, like I think during COVID and something like that, because like nobody was driving, Yep. So it's the same thing. Okay. And I think this might be the last one, but costs and fees of infinite banking, just to kind of do a recap. So the fees, the main fee is the premium payment. So the premium payment is paid until the policy is paid in full. The higher the payment frequency, the higher the payment. So basically, if you pay it monthly, then that's going to be the highest payment frequency. And then that will be the highest payment. So the cheapest payment would be if you paid your policy annually. And then part of the premium payment is going to be the base plus the PUA plus the riders. So the base is what you go in to pay for, like the death benefit and any policy fees and things like that. The PUA is the paid up additions. The PUA is, I would say, the one thing everybody should take away from this, because that's what your policy has to have in order for you to build the cash value. If it doesn't have a PUA, you're not going to be able to build the cash value. So what happens is the PUA, when it goes into your account, that's what gets added directly into the cash value and starts to create that overfunding for you to have the compounding. And then also the PUA is where your dividends, actually, let me go back so I should explain that. So when you get dividends, there's multiple things that you can do with the dividends. The best thing, in my opinion, to do is to have your dividends paid up as a PUA to keep that compound interest going. And it's very similar. I know I keep saying stocks because a lot of the stuff is the same. It's very similar to stocks when you do like the DRIP or the dividend reinvestment. Same thing with life insurance. And then the last part of the premium is if you have any additional riders, then those get added to the premium payment. Okay, and I know that there was a question in the forum, so this will actually help answer one of those. And that question was, where do I start? So when you were looking at creating an infinite banking plan, the first thing in anything you want to do, you should always get educated. Because when you're self-educated, you know for yourself what's real and what's not. And you kind of save yourself from some of the hurt and harm of being lied to and misled and some of those things. Because people take advantage of people who are not educated. Unfortunately, it happens a lot because there are some greedy people out there. The next thing is to know your needs and wants. And the reason I say that is because you can go to an expert, you can go to whoever, but at the end of the day, the job of whether it's an advisor, a insurance producer, an agent, or whoever you go to, their job is to help you achieve what you want and help you achieve your goals. Nobody is going to be able to create your goals for you because they need to be personal. And you need to know what's going to drive you and what you want at the end of the day. Now, once you know that, then you need to connect with an independent agent. The reason you want an independent agent is because they can shop between multiple carriers. If you go to an agent who only works for that one carrier, you're only going to get what they can give you without knowing what else is out there. The next one is you want to have policy options tailor-made for your goals. So depending on what your goals are going to determine what type of policy you should have set up, what type of riders you need, and different things like that. And then once you go through that, you want to select the policy. And once you select the policy, you'll go through the underwriting process to apply for that policy. And one thing I will say about the underwriting process is you got to be as truthful upfront in your policy of finances, health conditions, and any and everything, because these companies are going to pull up all that information. They're going to check your credit report. They're going to check your medical history. They're going to check your financial situation, your tax returns, all that mess. They're going to look at it. So if you don't say anything, they're going to find out. And then once you actually get approved for your policy, the next thing is to actually fund your policy. And once you fund the policy, then to be responsible and utilize the policy.